Welcome to Purdue Commercial AgCast, the Purdue University Center for Commercial Agriculture's podcast featuring farm management news and information. I'm your host, James Mintert, Emeritus Professor of Ag Economics here at Purdue University. And joining me today is my colleague, Dr. Michael Langemeier, who's the Director of the Center for Commercial Agriculture and also a Professor of Ag Economics at Purdue. We're going to review the results from the December 2025 Purdue University CME Group Ag Economy Barometer survey of farmers from across the nation. Each month, we survey 400 farmers across the U.S. to learn more about their perspectives on the ag economy. This month's Ag Barometer survey was conducted from the 1st through the 5th of December. And you know, Michael, as you look at it, the barometer fell 3 points this month to 136. That's about the same as this time last year, but it does leave the index 22 points lower than it was back in May, which was the index's high point in 2025. And, you know, if you look at what was going on in terms of what drove the change, current condition index at 128 was unchanged from a month ago. That left the current condition index at year end about 18 points below its 2025 peak, which was also back in May. Future expectations did drop, and that's what drove the change in the barometer. It was down 4 points to a reading of 140. That leaves that index down 24 points from its 2025 peak, which was also in May. So I guess two questions, Michael. Were you surprised at the drop in the barometer? And more importantly, maybe were you surprised at the fact that the motivator was the future expectations change?
It's always hard to tell exactly what's going to happen here in a kind of a short month, if you will. I mean, there wasn't as much time between the surveys as there typically is. I think there was only 3 weeks rather than 4 weeks. And I don't know if that factored in or not. But there really hasn't been a lot of news or a lot of changes. Changes in policy, that have came about, and so it wasn't real surprising that that was relatively stable. I thought maybe there'd be a little bit of strengthening in the current rather than the future, and so that's kind of the way I looked at that. I don't think the long run policy environment's necessarily changed in the last month, but that's just kind of my viewpoint on that.
Yeah, I was a little surprised at the drop in the future expectations. If I was kind of looking for a change in the current condition index, but I don't want to overplay that because the changes were small.
They're small.
Yeah. So one of the things that was kind of interesting is the fact that if you look at the report and look at the survey itself, when we asked people about over the next 5 years or widespread good times of expected in crops or livestock, the drop was in livestock, right? I mean, that was I don't know if it's not unexpected, but it was an 8-point drop. It went from 49% saying good times to 41%. Almost no change on the crop side, 2 points.
And it's remarkable that drop is like 30 points in the last 2 months. And so that's a big difference. That's a big change in the last 2 months.
And most of that, I think, is coming out of cattle,
yes.
Right? And people all of a sudden are less confident about what's going on in the cattle sector. They were really positive for a long time there, but all of a sudden, and we're still looking at high cattle prices,
yes.
and they're going to stay high for a while because expansion hasn't hit yet. So that was kind of an interesting point, I think. The other interesting point that showed up this month, which we didn't really highlight in the report itself, but it's worth maybe talking about it, and that is when we look ahead to next year, what are your biggest concerns for your farming operation? And there was no change in the ranking of what people chose. High input costs has been the top concern ever since we started asking this question now for the last, couple of years. But there was a jump in terms of more people were worried about high input cost. 45% of the respondents, I think, said that was their top concern.
There's been a lot of press. I don't know if this impacts people or not, but there's been a lot of press that's been talking about the tariffs and inflation and affordability. Maybe some of that. Maybe they're factoring in some of that. We were talking before the podcast. One of the inputs that has increased, compared recently is fertilizer. You were talking specifically phosphorus, and so maybe that's it. And so it's probably a combination of those two things. Maybe some more concerns about inflation, general inflation, which certainly would increase some of the production costs in agriculture, and maybe some of these relatively higher fertilizer prices are entering into their thinking.
Yeah, the other thing that took place, especially since our last survey, is there's been some press reports kind of highlighting the high input cost and basically trying to call out some suppliers for raising prices. And
Yeah.
so maybe it's kind of highlighted the issue in producers' minds, maybe a little more than otherwise. And of course, the other thing that takes place this time of year is people are purchasing inputs for the upcoming year. And so it's kind of the reminder of just how much
Yes.
things like fertilizer, seed, and other inputs cost. So the Farm Financial Performance Index rose 2 points in December to a reading of 94. That index is up substantially since October. If you look at it compared to October, we're up 16 points. That's still lower than it was back in May. I think that leaves us 15 points lower than in May, but it's been a pretty significant jump since October.
And soybean prices have been a little softer recently, but they're still up compared to what they were mid-October. And I point to that as being a very positive force when you look at this financial performance index. Of course, when soybean prices increase, that also tended to raise corn prices a little bit too. And so I really point to that news with respect to China, trade with China in late October is really being responsible for this.
That's an interesting point, and I tend to agree with it, although by the time we did the December survey, we'd lost some of that.
We lost some headways.
Looking at, for example, here in the Eastern Corn Belt, cash prices for soybeans dropping back below $11, right?
Yeah.
So good point, though. Farm Capital Investment Index, like the Performance Index, up 2 points, this time to a reading of 58. And although that index is up, we still had 60% of the respondents to the survey saying it's a bad time to make large investments. Yes. What's your take?
It's been sideways for a long time. I've been talking about the last couple of months, and so I don't think it's really moving one direction or the other. It's just kind of stable.
Yeah, and if you look at the next one, which is plans for farm machinery purchases, there's no evidence of any confidence rise there. In fact, the percentages said they were going to reduce their machinery purchases compared to a year ago. Actually went up a little bit this month. It went from 51% to 55%. No change virtually in the percentage of people who said that it's a good time. I think it went from 7 to 6%. Yeah. So we're not, even though the index went up a little, I don't think we're going to see any rush to the doors of the machinery dealers.
And I want to circle back to a question we had last month, and we asked a question about what would you do with your MFP trade payment when it looks like those are going to materialize now. What would you do with that? I think 10% said they would invest in machinery, so a very small percent. It's not zero. As I was talking to someone in the machinery industry, noted, it's not zero, but it's still a really small percentage.
Yeah.
And I think that just reflects how tight margins still are. Even with the potential of these payments, margins are tight enough that some people are going to have a little bit of trouble repaying debt. Yet alone buying machinery.
And you're right. We asked that question a couple of times, and the responses range between, I think, 10 and 12%.
Yeah, they're very small.
Yeah. So, if you look at the next one, which is the short-term farmland index, 117, up just 1 point compared to a month earlier. But maybe the bigger news is if you go back to September, we were at 106. So we're now 11 points higher than we were early in the fall, basically the beginning of harvest time. Are you surprised at the strength in that short-term farmland index?
Yes, I'm surprised in both the short-term index being relatively strong as well as the long-term index being relatively strong. I think the long-run index was either close or at its all-time high, and so it's a little surprising to me. That's really good news from a balance sheet standpoint, because obviously if land values hold, that means the balance sheet is going to be much stronger. And we did ask a question this month related to the strength of the balance sheet, and 68% said that their balance agreed or strongly agreed that their balance sheet was strong, and so certainly this is good news for farmers. But it is a little surprising to me that it's as strong as it is, because you look at the fundamentals, net income is not that strong, and also the interest rate I would think is more neutral. But I was looking at some of the factors that they said were impacting land values, and inflation has gotten a little bit more common as a response is related to land values. And so maybe that's part of it. I mean, the stock market's pretty high. I think that's also could be related a little bit to inflation, and maybe that's holding up these land values a little higher than they would be otherwise.
We talked, I think, last month about the fact that you've done a lot of research on farmland values and factors that influence it and what kind of a hedge it is against inflation. And one of the things I think you like to point out is that when there's a lot of uncertainty. People like to move money into hard assets, and gold, silver's at an all-time high.
And land would be
Farmland
consistent
would
with
be
that.
right in there. So that's probably a factor as well. Yet, if you look underneath the index and look at the raw responses to that farmland question, it's kind of interesting. The change in the index this month was not driven by more people saying they think farmland value is going to go up. It was driven by fewer people saying farmland values were going to decline. And so that's kind of a muted form of optimism, I guess, is how I'd characterize that, as opposed to being very bullish about
But that percentage you said decline is about the lowest it's been since 23.
Yeah.
So that was interesting.
Yeah. And then, as you mentioned, the long-term index, record high.
Yeah.
166, only 1 point change from last month. But, prior to that, it was at 161. And a little bit like some of the other indices, you go back to early fall. Now, it's up substantially compared to early fall. It's, I think, back in late summer, early fall, we were down about 146. So we're up 20 points compared to that. That's the 5-year outlook. Again, do you just think it's the inflation aspect and the hedge against inflation?
That has to be a major factor.
All right. So next one was, over the next 5 years, do you think ag exports are more likely to increase, decrease, or remain about the same? And, if there's any news on this one, it's the fact that we've got fewer and fewer people telling us they think exports are going to decline, at least when we ask the question in a generic framework, right? We just say ag exports. 2 months ago, 14% of the people in the survey said they thought it was going to decline over the next 5 years. Last month, that was cut in half to 7%. This month, it went down slightly to 5%. That's the big picture, right? And then when we asked a little more specifically about, soybeans, which was the hot news with respect to the trade agreement with China, we got a different response. 13% of the people in the survey said that they think soybean exports over the next 5 years could decline. Interesting contrast there in terms of how we phrase the questions. What do you make of that?
Yeah, very interesting. And if we phrase this question over 5 years, because just to remind the listener that the first year is supposed to be lower, the purchases from China are supposed to be lower, and then they're supposed to be bumped up in the second and third year. And the levels in the second and third year are similar. They're down a little bit from the historical average, but they're similar to the long run average. And so I found this really interesting that, even with I'm not going to say agreement, but even with that discussion that we had with China, there's still 13% think the exports are going to decline.
Well, maybe the next question helps explain that, because the next question we asked was, how concerned are you about the competitiveness of U.S. soybean exports with Brazil's exports? And when you add them together, I think 84% of the people in the survey said they were concerned about our competitiveness with Brazil. And maybe more importantly, 45% said they were very concerned.
Yeah, I'm so glad we asked this question, because we didn't really know. And we talked about this issue when we were drafting the survey. We didn't really know what this was going to look like. And anecdotal evidence, talking to the farm press, reading articles in the farm press, and then I've done a couple meetings recently. There's some angst out there about our competitiveness vis-a-vis Brazil, and so these results are showing that.
And I think with good reason, right?
Yes.
When you and I make presentations around the country, one of the charts I use anyway is I show how Brazil, South America in general, but Brazil in particular, has gained market share, not just over a couple of years, over decades, right? And so it's clear that they've been a long-run competitor for a long time. And of course, it eclipsed us in terms of both production and world exports. So it's a serious concern.
And one of the things I point out is they increase competitiveness every single year. But if you go back to the last time we had a trade dispute with China back in 2008, they're certainly more competitive, compared to 2018. They've increased production, and they have the capacity to export a lot more soybeans than they did back in 2018. And so it makes me more concerned when we have these disputes with China, because China doesn't need us as much as they did in the past.
Yeah, that's a good point. Yeah, when you look at those charts, and I always put a long run chart up when I make a presentation, there was a time when anywhere in the world, if you wanted to import soybeans, there was really only one supplier,
Yes.
and that was the U.S. That's not been the case for a long time, and it's been eroding for decades. So as we look at the next one, which is a question we've been asking since springtime, I think we started doing this in April. Do you expect the increased use of tariffs by the U.S. to strengthen or weaken the U.S. ag economy in the long run? And in the beginning, strengthen the economy was clearly the dominant response. First couple times we asked this in April and May, 70% said strengthen. That support for the tariff policy has been eroding. It's still a majority. 54% said strengthen this month. That's the second lowest percentage we've gotten on strengthen since we've been asking the question. And maybe more importantly, and we talked about this last month as well, we're picking up more people saying they're just uncertain. This month, it was 19% of the people in the survey said they were uncertain. Last month, it was 17%. The month before that, it was 16%. You go back to last spring, it was only 8%.
Yeah, that's a huge signal that people are just becoming more concerned.
Yeah, so clearly a shift. Not to the point where we have a majority saying they think it's going to hurt us, but we're getting closer. And then the question we started asking this summer, which was, would you say that things in the U.S. today are generally headed in the right direction or on the wrong track? We got one of the most positive responses we've gotten since we started asking this in July. 75%, 3/4 of the people in the survey said we're headed in the right direction. 25% said wrong track. Last month, it was 67% saying right direction and 33% saying wrong track.
I'm glad we included both of these questions. The first question focuses more on tariff policy. This is a more general question, and there has been some very positive things from a policy standpoint that have happened in the last year. The one big beautiful bill, certainly when you look at the ability to use Section 179 bonus depreciation and some other tax issues were very positive, for agriculture. It looks like we can get these trade payments, and that's also very positive. And so I'm not particularly surprised that they answer this stronger. They're stronger in terms of asking this question in the affirmative compared to the tariff question.
Yeah, that's a good point. The other thing is, I always tell people I think this question encompasses more than what's going on in agriculture.
Oh yeah.
So, it's you can interpret it. It's an open-ended question. You can interpret this the way you want to, but I strongly suspect it embodies much more than just agriculture. So that wraps up the highlights for this month's survey. You can get the full report on our website, which is purdue.edu/agbarometer. And if you're listening to this on the web, I'd encourage you to think about subscribing to our podcast, which is Purdue Commercial AgCast, which is available at all the major podcast providers. And of course, you can listen to it on the web itself without subscribing. And that website is purdue.edu/commercialag. So on behalf of my colleague, Dr. Michael Langemeier, and the Center for Commercial Agriculture, I want to thank you for joining us. And I'm James Mintert.